From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Wednesday the 22nd, 3 p.m. in London, 10 a.m. in New York. 30 minutes into the trading day in the United States. It is the equinox today. Awesome full starts. I'm Guy Johnson in London. Alix Steel is over in New York. Alex, Fed Day.
It is
That's
Fed Day.
Really, isn't it?
Finally, it's here. I guess the question is, what's going to throw the Fed off its track, if anything? And this is where the markets are. We've had a really interesting couple days, particularly here in the U.S. Yesterday really faded the close. Monday rallied into the close. So we're really set up for some question marks heading into the Fed. There we go. Let's just downsize it. Otherwise, I was a little teeny tiny person against a big board. Okay, so here's where you are, the Fed playbook. The S&P is up by about 0.7%. Most sectors in the green, energy, materials, all leading the way. I should point out, though, we're still looking at the worst month for all the indices being in the red since March of 2020. So just keep that in mind as well. Yields, again, they really go nowhere. The dollar, again, pretty much goes nowhere. Volatility continues to come down, but still slightly elevated. So it does feel like we're on our toes a little bit and a wait-and-see mode.
We've got existing home sales breaking right now. The next thing on my WECO list is the FOMC, so that's going to be the main event later on. But let's deal with the data right now because it continues to fill in the picture. A little bit of a fade. Existing home sales month on month down 2%. The market was looking for negative 1.7. I think we'll kind of take that as kind of a fade, not a big fade. The prior number was kind of revised a little bit higher as well. So we come in at 5.88. The housing market is slowing down a little bit, Alex, but there does seem to be continuing momentum broadly in that sector. We're just coming off a very elevated level. Yep,
it's just all about still that supply chain issue, too. Okay, so let's get to the two big issues and how they're going to impact potentially the Fed. Let's go to Washington. Debt showdown heading to a tipping point. The Democratic-controlled House passing a bill that would suspend the debt ceiling into December of next year. Republicans also vowing to block the provision when it reaches the Senate. The standoff raises the chances of twin fiscal disasters, a government shutdown, and a default as soon as next week. So here at the latest, Bloomberg's Washington correspondent, Anne-Marie Hordern. Anne-Marie, what's the lay of the land over the next 10 days?
It's going to be a busy one, Alex, as you mentioned, and this doesn't even have anything to do with the president's Build Back Better economic agenda. So the House has passed this bill. This is the stopgap funding measure to keep the government afloat past the end of the month, as well as the suspension of the debt ceiling. They link these two items together, and we already knew that going into the Senate, the Republicans say they will not have the votes because they refuse to put their name on raising or suspending the debt ceiling. So what happens next? There's a number of issues that can go on. What many see as the process is that there will be some sort of stopgap funding measure. And then alone, someone is going to have to capitulate on how we deal with the debt ceiling. The Republicans say they will not sign up for it. The Democrats do have the power to do it alone. And at some point, they're probably going to have to blink because, of course, this is about the health and fiscal responsibility of the United States. We should just also mention something to watch out for this afternoon. The president has an Oval Office meeting with members of the House and Senate from his party. And this is everything about making sure they can get that reconciliation package done in time.
Yep, he's trying to bring everybody together because they've been far apart. Anne-Marie Hordern, thank you very much indeed. We'll look for that meeting a little bit later on. What else are we watching? The story in China continues to cast a long shadow. The central bank injecting short-term cash into the system, basically trying to calm nerves over what is happening with Evergrande. Meantime, the property developer issuing a very vaguely worded statement on how an interest payment has been, quote, resolved, whatever that means. It was done off exchange. We know that. We don't know the details. The dollar bond is due. The payment on the dollar bond is due tomorrow. That's a major event. Tom Orlik, Bloomberg Economics chief economist, joining us now to give us his take on this. Tom, do we know anything about this? The response thus far has been to inject some short-term liquidity from the authorities. That certainly has calmed nerves. But do we need more? The resolution of this domestic bond seems to have calmed nerves a little bit as well. But as I say, there's a big bond coming due tomorrow.
Yeah, that's right, Guy. So Evergrande, China's troubled property developer, has already defaulted on loan interest payments due on loans to banks. We've had that vaguely worded statement suggesting some kind of at least short-term resolution of interest payments due on bonds. And as you mentioned, further bond payments falling due in the days and weeks ahead. The big question, is this a Lehman moment for China? Are they on the brink of some kind of financial crisis? Our answer to that is probably not. Yes, China's government does appear willing to allow Evergrande to default, to go into debt restructuring. They want to send a message that moral hazard is being removed from the property sector. And if you invest there, you face risks as well as hoping for returns. But we also think China's government is going to ring-fence this problem. You already mentioned it, Guy, the People's Bank of China active in the markets, preventing contagion. We think that's going to prevent this turning into a systemic shock.
All right, Tom, thanks a lot. Tom Orlick of Bloomberg Economics. Okay, not a systemic shock, but the question becomes, how is all of this going to weigh on the mind of the Fed when it issues its latest guidance this afternoon, plus the 2024 dot plot? Bloomberg International Economics and Policy correspondent Michael McKee joins us now with his Super Bowl. What can disrupt the taper? That's kind of what we're thinking about today.
Yeah, a lot of this could disrupt the taper when they finally get closer to the taper, but we don't think they're going to announce it today. Here's what to watch for. The Fed's statement in December of 2020 put this phrase into the markets. They're looking for substantial further progress on their goals in terms of the job market and inflation. Have they gotten there? Well, in July, they said the economy has made progress and they will continue to assess progress. This is from the statement. This would be your first clues. First thing to look at is if this statement changes and they use language that suggests that maybe they are close to it or about there or something like that, that would suggest that they are probably in the next couple of months going to change and announce a taper. But that's not going to necessarily be where we get the news. It could come from Jay Powell as well. The economic projections are the next thing you want to look at because the Fed has been really, really far off on their inflation calls. I mean, we're at 4.2% here, and we're at almost 4% there. So they've got to raise those. Now, the problem is the Fed says they're going to react to what happens with inflation, but they're behind on their forecast. They're moving their forecast to catch up. And so what do they say about that? How does Jay Powell explain where they go from here on that? And then, of course, the dot plot, everybody's favorite whipping boy here. The last time they met, 7 people moved into 2022, and enough moved into 2023 that we got a forecast for 2 rate increases. 2022, we could see some dots move over, although it would probably be for like December, and does that really matter? You know, it's so close to the end of the year. You'd need 3 dots to get a firm consensus for a move in 2022. And we may see this go higher. In 2023, we may see additional people expecting a rate increase or move that even higher. And then, of course, this is the long run. Does this move up or down? Do we think interest rates will get to 2.5% ever? That's going to be another question for the Fed. We also get the first 2024 dot plot, although that doesn't mean a whole lot because by then we could have 8 new members of the Open Market Committee. So whatever comes out in that today, don't worry about it.
Yeah, things are going to change pretty dramatically, as you say, as we shuffle the deck in terms of staffing. Mike McKee, thank you very much indeed. The biggest question for me today is the question that Mike is going to ask in the press conference. Closely guarded secret. But you'll be able to find out more a little bit later on. Tune into our coverage of the Fed decision. Simulcast on TV and Bloomberg Radio. It begins at 1:30 p.m. in New York, 6:30 p.m. right here in London. What do we got for you next? More on the Fed decision. JP Morgan's Jay Barry says taper tantrum, well, not on the cards right now. He joins us next. This is Bloomberg. So let's carry on the conversation about what we should expect from the Fed. The curve's flattening right now, down to session lows around 101 basis points at the moment. That's 5s to 30s. Investors are clearly worried about the prospect of a taper tantrum. Diameter Capital Partners co-founder Scott Goodwin, not so much. Goodwin and his partner, Jonathan Lewison, spoke exclusively earlier to Eric Schatzker on Bloomberg's Front Row on why it's an opportunity maybe for their credit investing firm.
Oh, I'd love it. I mean, we might lose money at the beginning of it, but we have our watch list, we have our process. Each analyst is ready. We're disappointed there hasn't been one yet. And I think that would be a great opportunity for us.
Because
what we'd rather do than do distressed or grind out returns in Netflix getting upgraded, frankly, is buy really good performing risk at a discount to par. And taper tantrums 2013 created an opportunity like that. It was there for maybe 3 to 4 weeks and it was gone. We really like those opportunities. You had a loan market type tantrum when the Fed changed its policy at the end of 2018. Loans went down 5 points. We put 15% of the fund in loans in like 2 weeks. So we'd be excited for that opportunity set. But again, like, people have been predicting that all year and it hasn't happened. So are you going to be positioned exactly right for it? No. And then you have to be able to change. So what does being able to change mean? We better run a low gross right now, which we are. And our gross is close to as low as it's been. We don't run a lot of gross because we have more trading velocity, and especially periods like now. We're sitting and being more patient. We're not patient people, but now it's kind of a time for patience.
Scott's excitement jumping off the page there goes a little bit to where we're different. So if you think about a taper tantrum, you're saying high quality bonds trade down.
That was the co-founders of Diameter Capital Partners, speaking exclusively to Bloomberg's Eric Schatzker. What I thought was interesting, Guy, is that the assumption that we will get some kind of taper tantrum that will then see some assets at a discount and provide a little bit more value. I think the Fed would really prefer there to not be any kind of taper tantrum.
Yeah, I think that probably would be what they would hope for. Maybe we've already had the tantrum. Maybe it didn't really exist for more than only a few minutes, a couple of days. And maybe that's already happened. Maybe they can manage the communication process a little bit better this time. I don't know. But what I got from that conversation is A, they've clearly got a team uniform, and B, that buying the dip, that mentality still exists in a lot of funds, including that one.
It does. It just brings up kind of the wild cards associated with today's meeting. And I just want to highlight a potential one. Now, it's over in your neck of the woods. A UK energy supplier now collapses and it's going to affect about 1.5 million households. I feel like we're seeing a rolling list of bankruptcies from this power crisis. And from what I understand, Guy, it's not necessarily that easy to transfer those 1.5 million households to another supplier because everyone's feeling the actual crunch.
Yeah, I think it's been multiple suppliers thus far, and basically these are the small, less capitalized, less hedged suppliers. We have a distributed model here in the UK. It is now obviously starting to condense. The government is in a position where it basically has to force the bigger suppliers to take on the customers of smaller suppliers, but many of those may not be profitable, so companies are really reticent to do so, and that's where the government has got to step in and help.
Yeah, I know that's a crisis over in the UK and Europe, but you can still understand kind of in the US how that idea of higher energy prices could be a risk. Hey, Jay Barry is JP Morgan head of US government bond strategy. Jay, you know, we laid out earlier the risks that could derail the Fed into what we expect them to do. Announce and taper in November and then start tapering in December seems to be the line of sight. Take a look at Evergrande, you take a look at, say, the surging commodity prices in certain areas and power issues, you take a look at DC. What throws the Fed off course here?
Morning, Alex. I think there's a few things that could potentially derail the Fed. I mean, Michael was talking about the Fed's projections before, and you know, we're actually tracking light on the Fed's growth projections for 2021, and we've revised our 3Q growth estimates down a few times in the last few weeks. We think it's only going to be temporary, but if it's more persistent, either related to the Delta variant or some of these supply shortages you've talked about, that's something that could derail the Fed tapering in December, particularly if it sort of slows the labor market. And I think that's the important point here. The Fed's acknowledged that it's made substantial progress toward its inflation goal, but it only made clear progress toward its labor market goals. So if we see another weak employment report at the beginning of October, where payroll growth slows once again and the unemployment rate doesn't decline, that's something that could certainly put it at risk. I think you could argue that the DC dynamics are a risk as well. I mean, it's clear that, or it seems likely that what's been presented by the House for the debt ceiling and the continuing resolution is unlikely to pass through the Senate. And we think at JP Morgan that this debate is likely to move on into October. But we do think that the risks of a technical default are pretty low. But I think those are the two things I can identify that could derail this from a November announcement.
We're light on growth, we're heavy on inflation. That seems to be the narrative that we're getting at the moment. Substantial further progress. We're not there yet, seems to be your suggestion.
Yeah, I think that's right, Guy. Certainly on inflation we are, but on the labor markets we're not. But we're getting there. And if the unemployment rate continues to decline, then that should put the Fed on a path to make an announcement in November. You know, even with everything that we've seen with the slowing in the economy over the course of the last month and the revision lower to growth forecasts, high-frequency indicators of the labor market, like jobless claims, have continued to trend lower, and I think are consistent with ongoing healing in the labor market. So if we see that continue, then we're on track for something in November, we think.
So it wouldn't take a lot, though, to shift one hike into 2022 and to move into 2023, and we're getting the first look at 2024. It wouldn't take that much. If we do get that, does the market take that as hawkish?
So it's funny, I mean, we've had all this discussion of taper, and we think that's less of an event than the dots. I do think that is on margin hawkish, Alex. The markets are pricing in about 100 basis points of tightening by the end of 24. If we're right and you see 6 hikes projected from the dots by the end of 24, that's 50 basis points more. So I think on margin that would be hawkish. That should result in higher Treasury yields, particularly in the intermediate sector as well, if we're right on that.
Jay, if the Fed decided to come out with news today and says, you know what, substantial further progress, we're there, we've made it, would that be risk positive or risk negative? The previous guests that we were hearing from on the tape were talking about their desire for a taper tantrum. If we were actually to get that announcement, would that be risk positive, though? Because it would signal that the Fed is pretty comfortable with where we are, not worried about the story in DC, not worried about the story in China, and as a result of which, we're in good shape. Would the market read it that way, or would it freak out?
Guy, I think that would certainly be a positive sign about what the Fed thinks about the current environment. But I think the bigger issue, and I'm just a humble rates guy, so I'm not a risk person per se, but if the Fed were to announce a taper today, I think the market would likely bring forward its expectation of rate hikes as well, because even though the Fed's done a good job of telling us that tapering asset purchases is something completely different from rate hikes, the guidance that they're giving us for both are the same. And I think we'd bring forward the liftoff date, and that would probably be somewhat negative for risk sentiment, all else equal, if we brought the first hike forward into late 2022 or somewhere around there.
Guy, you just said freak out. I feel like I'm rubbing off on you. It only took like almost 2 years.
Yeah, I'm not prepared to go as far as bananas at this point, but freak out I'm prepared to maybe talk about.
It's just a matter of time. He'll be cursing like a sailor. Okay, Jay, when you take a look at what the market is pricing, however, do we need to rethink where the neutral rate is, and then how that winds up feeding through any kind of cap that you might see in yields?
You know, at this point, Alex, we're not sure that there needs to be any change to the neutral rate. Certainly there are long-term structural dynamics, demographics, and productivity issues that have been dragging the neutral rate lower in the Fed's projections for the better part of the past decade, but it's been stable there for the last couple of years. And I think that could be a drag on an ongoing basis. But let's contrast that on the opposite side with what's happening cyclically here, right? The Fed is running monetary policy much easier than you'd expect for this point in the cycle, given its pivot to the FATE framework. And we're sitting here with the unemployment rate at 5.2% talking about tapering, when 6 years ago, the Fed was on the verge of raising rates at this rate. So I think cyclically, that's something that should bring more people back into the labor force, should raise trend growth rates to offset the demographic weakening, and probably keeps the longer run dot pretty much unchanged here. So without a doubt, the markets are pricing in about 100 basis points less tightening over this cycle than the neutral rate. But I think some of it's an expectation that the neutral rate may come down, but I think also some of it is that if the Fed has to go early in 2023, they may not need to tighten to 2.5% to actually slow the economy down, particularly if the concerns around COVID don't completely fade.
More than a humble rates guy to us. Jay, thank you very much indeed. Greatly appreciated. Jay Barry of JP Morgan. Thank you very much. Coming up, the maker of Cheerios, Häagen-Dazs, out with results of this morning. General Mills says it's expecting changes in consumer behavior to drive even more demand for food at home. Details next. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. U.S. mortgage lenders initiated 69% more foreclosures in August than the prior month after the expiration of a federal pandemic measure that prevented borrowers from losing their homes. The number of homeowners getting notices that start the repossession process grew to more than 7,000, the largest number in 8 months, according to mortgage information service Black Knight. And Netflix is buying the Roald Dahl story company, building on the partnership started 3 years ago to create a slate of animated TV series. According to a website statement from the company, one series in development is based on Charlie and the Chocolate Factory, whilst Netflix is also working on an adaptation of Matilda the musical. The deal is subject to regulatory approvals. And that is your latest business flash. Guy?
Rebecca, thank you very much indeed. US equity markets trading a little bit higher. General Mills is actually up around 3%. The packaged foods company posting stronger than expected fiscal first quarter earnings this morning. Think Häagen-Dazs ice cream. I'm sure Dave Wilson is a fan. Dave, talk me through the numbers, though. What are they saying?
Well, I mean, they're saying it's not just the earnings. It's sales and it's profitability that were relatively well received in their latest fiscal quarter. You look at sales, they rose, and analysts were anticipating a decline. So definitely a plus in that regard. In terms of profitability, that gross margin, now 34.7% was down by 1.5 percentage points from a year ago, but analysts were expecting a 2-point drop on average. So, General Mills looked good by that gauge as well. And then when you look at revenue, sure, people weren't buying as many cereals or whatever in the grocery stores. The North American retail business didn't do all that well. But, you look at two areas in particular. One, convenience stores and food service. People are going out, and so they're buying more General Mills products, whether it's Häagen-Dazs or whatever. And the other is pet food, and this is an area that the company's really moved into the past couple of years. First, they bought Blue Buffalo, and then in this quarter that they just reported on, you had the purchase of Tyson Foods' pet snacks business, and that helps things along.
If only they bring back coffee chip ice cream, that'd be huge for me. Okay, so we have a General Mills stock is up today over 3%, but it's really off those highs we saw back in June. What are we seeing reflected in the stock performance?
Well, I mean, this is a company that really has had its challenges for more than a year now in terms of the share price, because let's face it, beginning of the pandemic, we were all stocking up. General Mills was a beneficiary of that, and, the shares have come down. Profitability kind of holding the line relative to the past several quarters. The shares, not so much.
All right, Dave, thanks a lot. Bloomberg's Dave Wilson joining us. It was in the 80s, and it was just chocolate chips in the coffee ice cream. Now they have just espresso beans. It's just not the same. Just want to put that out there, General Mills. Okay, coming up. He's thinking about something to make fun of me for. Is Europe's power crisis going to spill over into the oil markets? Most say yes. The question is by how much? Jeff Curry will weigh in. This is Bloomberg.
Live from London, I'm Guy Johnson. Alix Steel is over in New York. This is Alix's moment in the show. We're about to see oil inventories dropping onto the screen. She's going to be super excited about this. The US economy is picking up. People are driving more. Consumption is definitely rising. I think the suggestion is we could get a fairly significant draw, which would continue that kind of narrative of recovery. But I think the most interesting thing that's happening in the energy market at the moment is the line between gas prices and oil prices.
Yep, and we'll get to that. So here are the numbers dropping right now. So overall inventories, you saw a nice draw, about 3.4 million barrels. That was bang in line with estimates, but about half of what we saw the week before, which would make sense as you see refiners starting up again after Hurricane Ida. You're going to see a little less of a draw. In terms of gasoline inventories, a touch of a build there. People going back to school, maybe traveling less. Summer driving season is a little bit on hold. Distillate inventory seeing a pretty nice draw as well. Refinery utilization picking way back up, over 5%. This is going to be a bit distorted because of Hurricane Ida. Remember, Shell's offshore operations in the Gulf of Mexico are still having a really hard time restarting. So there's still going to be that supply mismatch, which would explain why we're still going to see those inventory draws as refining company. You're laughing at me. That was instant analysis.
It's kind of,
you'd be the
this
same
is like
way.
a sort of instant. It's like a download. It's all got to come out. This is what's happening.
Oh my God, pot kettle black. Let's pause there and then go to the relationship between oil, that situation here in the U.S., and then the high power prices we're seeing over in Europe. Many are calling for more higher oil prices because of that. So the Nigerian National Petroleum Director talked about just that earlier today on Bloomberg.
Last year, there are a number of things happened under the investment in the gas sector, particularly entirely the oil and gas industry. The implication of that is that you're going to see the effect coming up in a year or two, max in a year or two, and that will also affect the gas supply all over the globe, and particularly in Europe. And that's going to show up in a number of gas-rich countries. A number of gas supply projects have been stalled. A number of midstream gas projects have been stalled or delayed. And the net effect will be that there will be a clear impact on pricing.
All right, joining us now on set in New York is Jeff Curry, Goldman Sachs Global Head of Commodities Research. Jeff, it's such a great pleasure to see you. Thanks for being here.
Great to be here.
So you heard the Nigerian petroleum minister talking about $10 extra for Brent because of the power crisis, gas prices. What do you guys see?
Well, it depends on what kind of winter you have. I mean, our main view is if you have a one standard deviation event, we're somewhere around $5 a barrel. But I think the big theme here is this whole idea of BTU convergence. You have shortages in coal, shortages in gas. We still don't have a shortage in oil because you're still drawing the inventories. But if you have an uptick in winter demand, we think that could add 600,000 barrels per day of demand. Then you have the oil demand itself, another 300. It's another potential million barrels per day of demand, which then you force oil in line with the rest of the energy complex. But I want to emphasize, you looked at the inventory numbers. It's just a continuation of everything we've seen since June of last year. Only thing that's changed over the course of the last, say, 12 to 18 months is the risk profile. Let's go back to July and August. We went down, dipped down to 65. Delta risk around demand. OPEC and Iranian supply coming on. U.S. shale drilling picking up. Now, what has changed? All three of those have reversed. Now we have a potential for gas pushing demand higher. When we look at OPEC, they've disappointed. Iran's probably taken off the table right now. And you have the Gulf of Mexico disruption. So you put it all together, all the risk is shifted to the upside. So we stick to our $80 target with potential risk, $5, maybe even $10 higher than that, depending on what kind of winter weather we get.
Here in the UK, there is a growing expectation, Jeff, that energy prices, gas prices in particular, are going to stay higher for longer. I appreciate what you're saying about the weather, and it does look as if the weather is going to play a huge factor here. But nevertheless, the expectation, Kwasi Kwarteng, the business secretary, was talking about this earlier in the House of Commons. We need to get used to higher gas prices. Is that your view as well?
Oh, absolutely, yes, particularly outside of the U.S. When we look at LNG, it's the type of demand that we have coming out of China, creating a tight global gas market. Combine that with disruptions in Russian supply going into Europe, low inventories, strong demand coming from substitution away from coal, given the emphasis around climate change. Yes, these are with us to stay, and I think the issue is. The supply chains are so severely depleted, the system cannot accommodate any type of disruption. And it's those types of, small disruptions in supply, stronger than expected demand that sends prices to $22 an MMBTU, as we saw about a week ago.
What's interesting, though, that prices still aren't high enough to divert flows from Asia into Europe. What's the price shift when we either see big demand destruction or when we see big shifts in where the cargoes are going?
Well, when we talk about demand destruction, just substitution you're talking about is the first line of demand destruction. In fact, I like to point out oil is the cheapest thing on your screen right now. So when we think about the type of demand destruction is, hey, we need to get more gas. We're going to get it through using oil, which we don't want to use because obviously it creates more emissions, require more carbon credits to do it. But I think that's your first line of demand destruction. To get to the actual demand destruction, we're talking far higher prices because when we talk about heating demand and gas demand, it's the most inelastic demand out there.
Demand destruction on one side, but is this going to does this slow or accelerate the energy transition?
The higher prices should accelerate it. The question is, what kind of backlash do you get from the public or what kind of backlash do you get from policymakers? But the bottom line, higher prices do nothing but make renewables and other types of alternative energy look far more attractive. And I think that that's really, in one way, you have the EU environmental directive cheerleading higher carbon prices, but this is the consequences of higher carbon prices, that it does speed up this process, making coal more expensive, wanting to consume more gas in a really tight market, just creating and reinforcing this dynamic.
What about about other commodity markets? So we saw over in the UK that CF Industries shut down 2 fertilizer plants. That's also going to be fixed a little bit. But does it disrupt the fertilizer market, steel market, aluminum market when we have these high input prices?
Oh, absolutely. It's having an impact on, in fact, you look at the cuts in aluminium production capacity, both in China and disruptions in Europe, it's all driven around power markets. One thing that China is trying to do right now, conserve coal inventories as they go into the winter to prevent type of some big disruption. Best way to do that, cut alley production. We're seeing it in Europe and we're seeing it in China. Also, as you point out, fertilizers, raising the cost of producing agriculture. So yeah, the implications of this are huge and we'll feel it through the economy.
Aluminium, you heard that, right?
I just said it.
I've been living over there too long.
He's been in London too long now.
Let's talk a little bit about Evergrande. We're seeing a read across into a number of different metals. We're seeing an impact, obviously, in the iron ore market at the moment. We were talking to one fund manager the other day that drew the line between what's happening with Evergrande and copper. Draw the connection for me, Jeff. How are you seeing it working? Are the problems in the property market in China going to have a meaningful impact over the medium term into the metals market?
Well, let's take the Evergrande situation aside, because the Chinese government's just going to ring fence it and back it, because the implications, they don't want it to have any type of contagion to the rest of the economy. Now, the question is, how severe is the slowdown in the property market? One of the reasons why the government is going in there and purposely slowing down new starts, because the backlog of projects is enormous. So when we think about copper goes into the completion of a construction project, not the starts. Iron ore is down because steel goes into the start. Iron ore and steel and cement and things like that go in the beginning. Things like nickel, stainless steel, copper, wiring, plumbing, all of that goes into the completion. The backlog is huge, which means we should see that type of demand continue to increase well into 2023, at which point we have the green revolution begin to take over and drive copper and nickel demand.
We have like 30 seconds. The gold, you like it?
Yeah, we like it 2000. I think the big question is, how do you get investors back into not only commodities, but gold and an interest in the reflation theme? You know what I think does it? $85 crude has people back in these markets.
All right, fair enough. Jeff, so good to see you. Thank you for stopping by. Really appreciate it. Jeff Curry of Goldman Sachs. All right, coming up right now, you got Uber saying and expecting to return to office by January and going to be requiring vaccines. We're going to speak to the CEO next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, U.S. Special Presidential Envoy for Climate John Kerry, 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg.
From London, I'm Guy Johnson. Alix Steel over in New York. This is Bloomberg Markets. Alex, Uber's stock taking quite a ride. The company boosting its third quarter outlook. We may be about to see this business turning profitable on an adjusted basis. And that obviously has really enthused investors. The stock is up nearly 15% over the last couple of days. Joining us now, the CEO with Emily Chang.
Guy, thank you so much. I want to welcome our Bloomberg television and radio audiences and bring in Uber CEO Dara Khosrowshahi joining us live from New York. Dara, great to have you back with us. I want to start with the bigger picture because I just interviewed Airbnb CEO Brian Chesky yesterday, and he told me he thinks a revolution is happening in the way we travel from business to leisure. Do you think a revolution is happening post-pandemic in the businesses that you run? Rides and the way we order food, or will life revert?
Well, certainly there's a revolution happening in terms of delivery of all things to your home. It started with food, but it's going to continue with grocery and pharmacy or your iPhone, et cetera. And just in 4 years, our Uber Eats business has gone from a $2.5 billion run rate to a $52 billion run rate. And we think there's so much more to go. Users want what they want at their home right now. You know, it used to be that next day delivery was awesome. Now it's all about next hour delivery. And what we're doing is empowering any local merchant to essentially get anything that you want locally to your home within hours. And clearly eaters and users love it. And we think it's a trend that's going to continue over the next 5 to 10 years.
Now, you just revealed Uber could post its first profit this quarter. What are the levers that you can and will pull to determine whether that happens this quarter or not?
Well, I think what's happening now is our marketplace is becoming much more balanced. If you looked in Q2, the demand for moving around and getting things to your home essentially was increasing at a much faster rate than supply. We had to invest very aggressively to bring more drivers onto the platform or couriers onto the platform. And you're seeing the benefits of that in Q3, where the marketplace is much more balanced. Our margins are coming back to normal. Our mobility margins actually are going to be equal to pre-pandemic levels, even at lower volume, because of the moves that we've made in terms of automation. And our Uber Eats business is both growing the top line, but now is getting to EBITDA profitability levels as well by the end of the year. So really now things are working out quite well for us, where we can grow the top line, but we can do so profitably on a sustainable basis for some period to come.
Still, you're continuing to work on driver supply around the world. There are price surges that we as riders are certainly feeling. You've said that price surge will ease up by the end of the year. Without that, do you see long-term profitability? Will you hit that milestone quarter after quarter?
Well, absolutely, we do. And we're seeing the prices essentially stabilize now. Our surge levels are coming down. ETAs now are the best that they've been since the beginning of the year. And conversion rates, as far as the percentage of users opening the app and getting the service that they want, whether it's food delivered to their home or whether it's they're going somewhere, all of these metrics are moving in the right direction. So we think we can be profitable, but we can be profitable delivering an amazing experience to riders and eaters, and also really strong earnings level to our earners.
I want to zoom into the UK in particular, where you are seeing longer wait times. Drivers are going to other apps. They're moving on to other sources of income. When do you see a better balance between supply and demand?
Well, I think what we're seeing in the UK is that demand right now in the UK is at 20 to 40% higher than pre-pandemic levels. I mean, the UK is really opening up, and it's amazing to see. The number of drivers that we have on our platform now is as high as it was pre-pandemic, but it hasn't caught up to the growth in supply. So we're going out there in the UK now, and we are looking to bring on 20,000 more drivers onto the platform. The earnings opportunities are better than they ever have been. And as far as the service goes, you know, over 60% of the time you're getting your ride within 5 minutes. 90+% of the time you're getting your ride within 10 minutes. We want it to be faster, but the service is now working the way that we want it to. And there's a ton of earnings opportunities, and hopefully we'll get more drivers onto the platform to catch up to the incredible demand that we're seeing.
DoorDash's market cap briefly surpassed Uber's in the last week. The stock's back up, but it was kind of a close call. A former Uber executive called that a nightmare. He invoked a comparison to Yahoo. How do you respond to that?
Yeah, I think I wouldn't put a lot of credence into that particular former Uber executive. You know, it's a point in time. The fact is, if you look at our volumes are twice as high as DoorDash's, and we're growing faster. Our revenue is 3 times larger than DoorDash, and we're growing faster. And based on third-party data in the US, our Uber Eats business is the fastest growing food delivery platform in the US. So we're very confident as to where we're going. And I think this is a point in time in terms of relative market caps that I don't think you're going to see again.
DoorDash is getting into alcohol delivery. Investors are betting they're going to be big in grocery. You did buy the grocery delivery company Corner Shop earlier this year. We saw that partnership with Albertsons, but when are we going to see your grocery efforts really scale up and bear fruit?
Well, I think it makes a lot of sense for DoorDash actually to follow us into alcohol delivery. We've been there for over a year. We have alcohol delivery now available on Eats in over 20 countries. So it makes a lot of sense for them to to follow us there. As far as grocery goes, we have focused actually outside the U.S. first. We think we can be the winner in Latin America, which is Cornershop's home turf, so to speak. We're aggressively expanding grocery in France, in UK, countries like Taiwan, Australia, etc. And in the U.S. now, we have a really strong tie-up with Albertsons and Costco, and we're going to essentially expand with the partners on a local basis.
Meantime, very important situation brewing in Texas. Uber and Lyft have said they'll pay the legal fees of drivers sued under this new Texas law banning abortions. You donated $1 million to Planned Parenthood. If other states passed similar laws, would we see you do this elsewhere? Does Uber support a woman's right to choose on a national level?
Yeah, we absolutely do. And I think more importantly, we don't think that drivers should be sued by private clients. We think that's unprecedented. It's wrong. And if it happens in another state, we're going to stand behind our drivers just like we did in Texas.
Meantime, Dara, your CTO stepped down, and you have made the unusual decision to become acting CTO. So you've got now these highly technical executives reporting into you. I'm so curious, how are you preparing for this new responsibility? That's a really critical job.
It is. I was an engineer back in school, so I get to geek out now. And I think at Uber, we have the best technical capabilities in the space. In my working directly with our top engineers, we have an incredible bench. So, I'm actually looking forward to it. We have a great bench that we're working with, and I think we can keep innovating, and I think we can keep shipping products faster than any of the other local players out there.
So speaking of some of your other bets, you recently made a visit to Joby. You watched one of their flying taxis take off. Of course, you've also got self-driving with Aurora playing out. How do you see these other bets on self-driving cars, flying taxis playing out? Is this the real travel revolution that we need to wait for?
Well, I think all of these technologies are happening. The pace at which they happen, I think, actually is going to depend a lot on the regulatory authorities. The Joby tech in terms of flight range, in terms of sound, is extraordinary. I got to experience it myself. And obviously the certification process is going to be the most important factor in bringing this technology to bear. And with Aurora as well, we're thrilled to be working with them both on the trucking side and the rideshare side. And I think it's about safety first, and the technology leaps that we're seeing there are super encouraging. So these are two best-of-breed teams, along with Lime, who is the leader in terms of e-bikes and scooters in the world. And we have strategic investments in each of these very important areas. And we love our investments because we've made the investments in what we believe are the best teams and the leading teams in each area.
All right, Uber CEO Dara Khosrowshahi. Dara, always good to have you with us. Thanks you so much for joining us live from the Skipped conference happening now in New York, focused on the future of travel. Back to you.
All right, thanks so much. Bloomberg's Emily Chang joining us there. Guy, I thought it was interesting. He was saying that the UK demand is quite high, about 20 to 40% higher than pre-pandemic. I can tell you here, wait times are super long. Like, there's definitely the demand. I have to wait like 15 minutes sometimes for a car.
There's a labour shortage, and it's a bit like the haulage industry, isn't it? Is this a occupation of last resort? That is a question that I think, obviously, the whole of the transport sector is having to deal with right now. I want to go and stay at that hotel. I am a massive fan of the Constellation. You could see that aircraft behind Dara. Very beautiful.
It's so cool.
I love that aircraft.
I've been there. It's awesome. This is Bloomberg.
I'm going to go and stay there.
90 minutes into trading right here in the U.S. The move is in the dollar as well as bond yields here. You have dollar around the lows of the session. You also have yields on the back end pushing their way lower just a touch. The curve keeps flattening. The 30-year keeps moving lower as well. We're about half an hour away, though, from the close of the European session. Here with more to break it down is Radhika Gupta. Hey, Radhika.
Hey, Alex. Yeah, the stock 600 higher here for a second day, up some 0.9%. But of course, a lot of the focus now on the FOMC. In terms of your best performing sectors, it's basic resources here really pushing us high today. This was actually the worst performer yesterday, but now the miners getting a bid. A lot of this coming from your commodity story. Iron ore higher in that Singapore session, above $100 now. And then, of course, I point to natural gas futures. This is the Dutch front-end contract down for a second day, but we're not out of the woods in that picture. Let's flip up the board. Most of the sectors really in the green here, but of course I mentioned some of those miners really leading the way here. And of course, this is Antofagasta and Glencore here up. And also some of these gambling stocks in the UK, of course, after that bid, and the highest in the stock 600. And then back to you, Guy, Alex.
This is Bloomberg.